Joining me right now, Tony Zabiegala is with us because we have this higher for longer idea from the Fed, and I'd love to hear what you're talking about here. Tony Zabiegala, Chief Operations Officer, Senior Wealth Advisor, Strategic Wealth Partners. Thank you for being here. So how are you feeling about the economy overall and the markets?
Yeah, so what? The S&P 500 is up 6% year to date. But the S&P equal weight is up 2, and the Russell 2000 is negative. So this higher for longer narrative is actually killing small and mid-cap stocks. And the result is that you have all these investors plowing into mega tech and AI stocks with both feet. And honestly, this isn't good. This isn't a very sustainable formula long term. But short term, it is an election year, and the market really isn't disappointing because normally election years are positive on historical data. Now, the market just continues to grind forward every single day, and it's hard to argue because inflation is normalizing. I know we got a hot inflation number earlier, this week, but inflation is normalizing. Everyone has a job, and the consumer is still spending because they have a job. So I feel that this market will end the year higher, but we could see some turbulence. But it's hard not to jump on this ride and ride this wave. But investors really need to be responsible. And the biggest takeaway and the biggest key to this is manage risk appropriately.
So when you say that what we're seeing now, people have been plowing into tech and AI, breaking new highs. We've had, most weeks have been higher over the last, let's say, 15 weeks. Most have had up arrows. But you're saying it's not sustainable. Something's got to give. Is that right? Could you explain that more?
So, sorry, say that again. Extend what?
Well, just that it's not sustainable. Like the markets cannot keep running the way they've been running. Is that what you're saying?
Yeah, I mean, the reason this market can go up, again, I said inflation's normalizing, people have jobs at an election year, but there are things out there that can bring this market down, like geopolitical risk. There's several wars going on, just people continue to seem like they forget about that. Potential 2024 banking crises could pop up. And again, the biggest headwind, and I mentioned it before, is higher for longer. The small businesses, when they need to refinance debt or bring on new debt, it's going to be at higher rates. So that's going to squeeze margins. They're going to have to make decisions. Do they want to grow or do they want to just sustain? So we have to watch out for just some of the speed bumps that are out there. But there's too many. I think there's too many positive catalysts than negative catalysts.
Right. So at this point now, when you talked about how it's been killing the small and mid-cap names, you do have some names that you brought to us today, like Cameco and Darden. Tell me a little bit about why those maybe could work.
Right. So a year ago, I was on your show, and I was talking about Cameco when it was in the mid-20s.
Yep.
And as it's been approaching $50 a few months ago, we've been trimming along the way. But right now, Cameco's down about 20% in the last few weeks. And my team has talked about this. If Cameco dips below $40, we're considering buying more, and here's why. Nuclear power is a secular growth story, and it goes beyond the consumer, the economy, inflation, future rate cuts, and even who the next president of the United States is. The one thing is like there's a big push for AI. AI is a very big energy suck. So it's kind of like Bitcoin. Mining Bitcoin takes a lot of energy. It takes a lot of data centers. It takes cooling centers. Same thing with AI. But there's also this world movement towards a carbon neutral energy source. And the alternatives like solar and wind, they're just not ready for prime time. So that's why we like nuclear. It's got a 50-year track record. It's reliable, cheap, and proven. And that's why we like Cameco.
Right, understood. And then what about Darden? People are still, maybe they're pinching the purse a little bit, or maybe they're not getting a dessert or something, or extra appetizers, but people are still going out and spending, aren't they?
They are. And you know what? Darden came out in their earnings report and said that. People are still spending because, again, they have jobs and they want to enjoy it. So Darden operates over 1,900 locations in North America and overseas. So think about Olive Garden, Longhorn, Capitol Grill, Ruth Chris. Now, they drive revenues through cost efficiency, brand awareness, and technology in all of their restaurants. Again, the positive is that consumers are spending on dinner remains pretty resilient. And they also have preserved the value on their menu because their price hikes have gone up with their food, but not as much as inflation. So people are enjoying that because they're not spending as much as if they were to go to a different type of restaurant. As for the stock itself, it's got free cash flow, a 3% dividend, and over a $3 million stock buyback program still authorized. And personally, I've been to some of the best restaurants in the United States, and I'll tell you what, Longhorn filet is super underrated. It is a very good steak.
I'm going to leave it right there. Tony Zabiegala, Chief Operations Officer, Senior Wealth Advisor, Strategic Wealth Partners. Glad Tony was able to be with us.